All right, so this last financial statement that we're really going to talk about in this class is the statement of cash flows. We're not going to go into any great depth about it right now. We'll talk about it a little more in Chapter 2. We'll get a little more detailed about it. And then in Chapter 11, you'll get into much greater detail about the statement of cash flows. Now, I will say, as far as I know, we won't be preparing any statement of cash flows. They can get very confusing. They can get very messy. So typically in this class, if you need numbers from the statement of cash flows, or you need to do analysis from the statement of cash flows, that's going to be provided for you. We really just want you to understand what goes on it and why we need to produce one. So statement of cash flow really just does measure receipts of cash and any payments of cash. So anything involving cash, those are inflows and outflows. Inflows would be cash receipts, right? We get cash. Outflows would be cash payments. We're giving cash away. Okay, and again, this one, if you'll notice here, is an interval of time. This is for the entire month of December 31st, 2024. So we're going to separate these out into the three different activities that we talked about. So the first one would be operating cash flows. This is going to be any cash receipts or cash payments that involve revenue and expense activities that we had during our normal operations. Next, we'll have the investing cash flows. This is going to include any cash transactions for purchase and sales of investments or long-term assets, like if you were a delivery service and you sold an older van, that would be part of your investing cash flows. It would be an inflow of cash, right? If you use some of those proceeds to purchase a new van, that would be an outflow of cash for your investing activities. Again, this is investing because you expect these assets to help your business, to help you generate revenues and profits over a certain period of time. So these are investing. You're investing back in your company. And then finally, you've got your financing cash flows. These are just how are you generating your money? How are you getting capital, right? So are you borrowing money? Are you repaying that money? Are you issuing stocks? Are you issuing bonds? Are you paying dividends? Are you paying back balances on bonds? Those kinds of things. The last thing I want to note about this is this cash at the end of the period. This is going to be in your balance sheet, right? So you're going to get this from your balance sheet as kind of like a check. You've actually got a couple of checks here for yourself, what we call check figures. You've got your net income. That comes directly from your income statement, right? And then you're going to have your cash at the end of the period. And there are ways to check to make sure you have done this correctly, but we'll get into those as we get to like Chapter 11. So the next thing we're going to talk about is demand for financial accounting information. So like we talked about in Part A, the accounting really does play a critical role in communicating the story of a company. That's the way I like to explain it. Again, we really are, with these accounting numbers and these measurements, the communication that we're sending out to these external parties is the story that we're telling about the company, right? So to this point, we've already presented kind of a simple look at how the financial story of a startup company is measured. So we use that Eagle Robotics. They had a lot of beginning balances that were zero, right? As we move through chapters, we're going to look at more detailed views of these measurements and the communication that we use for these measurements. But before we do that, we really need to understand a little bit more about the demand for accounting information, the demand that external users place on this, and the role that we as accountants have in helping users to make decisions, and the role of even understanding accounting, how you can help these users make decisions. So the first thing we're going to talk about is just the role that financial accounting plays really in the decision-making process. I've always felt like, since they came out with this this little visualization here, I felt like this is a great way to kind of explain accounting, because typically people just thought of accounting as we crunch numbers and we put out a report, right? But what accounting really is this graphic right here, right? There's a bunch of activity that's happening. It's all financial activity that we're going to measure, right? There's a lot of shades of gray in there. We're going to have to make some judgments as accountants. We call that professional, using your professional judgment as an accountant. There's shades of gray we've got to use. We use those good judgments to create useful information that is useful for those external users. And then they go on to hopefully make good decisions using the information that we had, right? And when all those good decisions are made, you can see that there's a prosperous society, right? The big thing with accounting is really that it does take, it requires some judgment, and it does take some critical thinking skills, right? But you can see how the flow of this chart works. Here we've got just a quick, this is something I talked about when we first started this chapter. This is what is the relationship between stock prices and net income, right? And we can see here that if we had a large increase, that green line in net income, that our stock value went up, right? Stock value rose. Well, if we had a large decrease in net income, the stock value fell. So you can see where knowing the net income number, knowing how that number is derived, can help you make a really well-informed decision based on really basic information that the company provides you. So now let's talk about accounting standards, right? Since we have people making really important decisions, these are not all just people buying 15 or 20 shares of stock. These are some people that are buying thousands and thousands of dollars in stock at a time. These are banks that are lending out millions and millions of dollars to a company. It is important that the information that these decisions are being based on has formal standards. Okay? These formal standards in the United States are called generally accepted accounting principles. You will hear me mention this a lot throughout the course of this class, because these are the rules that we follow in this class. These are the rules that we follow for publicly traded companies that use accrual accounting. So you can see here, we've got investors and creditors. They're going to make their decision based on the information that we provide them, and that information should be based on these formal standards, GAAP. Okay, that's what we call this. We just call it GAAP. So if you hear somebody in the accounting department say GAAP, this is what we are talking about, generally accepted accounting principles. So standard setting and the objectives of financial reporting. So standards for GAAP are set by the Financial Accounting Standards Board, which we pronounce FASB. I told you guys we love acronyms in accounting. This is just another one. We are just getting started, believe me. So FASB, the Financial Accounting Standards Board, are who set the standards for GAAP. FASB is then governed by the Securities and Exchange Commission, or the SEC. So actually kind of the way it really broke down was in 1933, they created the Securities Act and the Securities Exchange Act, right, in 1933 and 1934. The one in 1933 kind of set forth some accounting, some disclosure requirements for the initial offering of stocks. And then in 1934, they needed to go a step further, and so they created the Securities and Exchange Commission, and they gave the Securities and Exchange Commission authority to set the standards. Well, the SEC, as we call it, decided that they wanted to allow another governing board to set those standards, and so they have given the FASB the power to set those standards, right? So that's kind of the way the flow of that works. However, just know that, let's say the FASB does something that the SEC does not like. The SEC can go back and say, hey, we really are the ones with the power here. We're allowing you guys to write these standards and to try to set these standards, and there's a huge lengthy process to that. But if the FASB finally does something that the SEC doesn't like, the SEC can go back and force them to change that standard, and it's done that in the past. Most other countries outside of the U.S. Follow the International Financial Reporting Standards, or what we call IFRS, but we're not going to be covering IFRS in this course. There was a great debate for several years about bringing IFRS and bringing the IASB and the FASB together, so bringing IFRS and GAAP closer together so that it was easier to do international accounting. There were some issues that the United States felt like we could not bend on, some things that the that IFRS does that FASB did that GAAP does not like to do, and so just last year, the year before, it was finally decided that hey, We're not going to deal with IFRS anymore. They can have their own thing. We're going to have our own thing, and we're just going to move forward. So, just real quickly to reiterate, right? These are the objectives of financial accounting. Financial accounting should provide information that is useful to investors and creditors when they're making those decisions. Okay? It needs to help. It needs to be predictive in nature, so it needs to help predict cash flows. And it needs to tell about the economic resources, the claims to those resources, and changes in resources. So your economic resources being your assets, claims to resources being liabilities, what you owe to people, and changes in resources being kind of like your cash flow statement or your equity, right? And then any claims. So it has to be faithful. It has to be faithfully represented. Somebody should be able to look at that and know that there's not a material misstatement there that's going to cause them to make a poor decision based on poor information.